Hi, I'm John Palmer, Head of Real Estate Strategies at Westwood. And I wanted to take a quick moment to share our mid-year update on the real estate securities markets, highlighting how REITs have performed year to date, which sectors have outperformed and which have lagged, as well as shares my outlook for the remainder of 2025. But to set the stage, I think it's first helpful to provide some macroeconomic context. First, as we saw in today's jobs report, the U.S. labor market remains strong, with broad and consistent job growth across large segments of the U.S. economy. The current unemployment rate stands at 4.1%, which is an encouraging sign. Secondly, inflationary pressures have largely receded from their peak a couple of years ago. The current CPI reading came in at 2.4% on an annualized basis. And while this is above the Fed's target of 2%, it's in a meaningfully contained range, which gives us a lot of comfort. Third, corporate profits remain strong, with analysts expecting top-line revenue growth of 4.9% and bottom-line earnings growth of 9.1% for the S&P 500 for 2025. So corporate America is doing quite well. With that context, it's important to focus on the interest rate landscape. As you can see in the chart, the 10-year Treasury started the year at 4.57% and ended the second quarter at 4.23%. So interest rates did come down over the first 2 quarters of the year. Obviously, there was a fair amount of volatility in early April when the Trump administration announced their Liberation Day trade and tariff policies, and spreads on both investment grade and high yield assets did widen out. However, by the end of the quarter, spreads were largely in line with where they started at the beginning of the year. Now, the big debate is what will the Fed do between now and the end of the year? The current debate is whether the Fed is going to cut once or twice before the year is done. I'm in the camp that we will see at least one cut before the year is out, which should be helpful to real estate securities. Now, shifting to REIT returns specifically. On the next slide, we highlight how the publicly traded REIT sectors performed for the month of June, as well as for the first 6 months of the year. The month of June was notably muted, with a few sectors outperforming and a few sectors underperforming. On the outperformers, the notable ones were lodging, timber, and the regional malls, whereas the laggards were data centers and healthcare. However, the more interesting story is looking at the dark blue lines, which highlight the first 6 months of the year performance for the various property sectors. The clear winners and losers are separated by a fair margin. The winners were infrastructure or the tower REITs, healthcare REITs, diversified REITs, which are REITs that have more than one property sector focus, as well as freestanding or net lease REITs. The losers were the shopping centers, office, data center, and lodging REITs. And it's interesting to think about REIT performance in the context of the broader market. REITs for the first 6 months were up modestly, but as you see on the next slide, we have broken out the S&P 500 by its 11 GICS sectors. And as you can see here, for both the second quarter as well as year to date, REITs are towards the bottom half of the pack, which we think sets up for an attractive reversion to the mean trade for the final 6 months of 2025. Now, whenever we think about our forward forecasts, we balance them by both fundamentals as well as where spot valuations are at. On the fundamentals side, REITs generally have been very, very resilient. Buildings are generally full, tenants are healthy, releasing spreads are positive, and the capital markets have been generally constructive for REIT financing. So fundamentals are doing quite well and should lead to consistent cash flow growth. Now, on the next slide, we shift towards valuations. On this slide, we show where implied cap rates are. That's implied by today's prices by property sector. And as you can tell, there's a wide discrepancy between the tightest sectors and the widest sectors. Sectors like office and hotels are trading at the widest we've seen in quite some time, whereas healthcare is trading at a meaningfully tight cap rate. Shifting to the next slide, here we show that same valuation framework in a slightly different context. We look at premiums or discounts to consensus NAVs. And again, as you can see in this slide, you have most property sectors trading at discounts to NAV. Some of them are trading at meaningful discounts to NAV, whereas you do have a handful of property sectors trading at premiums to NAV, notably healthcare. But my point of when looking at these slides would be that active management allows you to craft a portfolio sector by sector, name by name, where you can find attractive fundamentals matched or paired with attractive valuations. My view is the setup for the remainder of 2025 is very attractive. Fundamentals remain resilient and valuations are equally attractive vis-a-vis the private markets as well as other sectors out there. So we look forward to having a really strong second half of the year with an attractive risk-adjusted return potential. Feel free to reach out to Westwood if you have any questions, and I look forward to sharing updates in the months ahead. Thanks again.